the second to last class we have together. My plan today is to finish up options from last week. So in terms of options, I will now go over what hedging looks like with respect to large and small drops in value. Um, and then I'll briefly talk about pricing. So my understanding is almost all of you should have some background in pricing, so I'm not going to spend too much detail on it, but just in case, I will give you just a broad overview of why option pricing is just different than classical asset pricing stuff, which you've seen in, looking at stocks and bonds. And then I will talk about a special topic on options on futures, which is supposed to help you realize that you can use options and futures together to kind of understand what the market forecasts about the future. And so hopefully this gives you another tool as an investor slash policy analyst to kind of see what everyone else is thinking. This kind of stuff you do see is available to you on, for example, Bloomberg if you look for it. But now at least you know how it's derived. Of course, you don't have to know the machinery to see it, but my point is to give you some idea of how it's derived. Okay, and then the last topic is cryptocurrencies. So I will give you just again a very qualitative description of cryptocurrencies and why it's different than the stuff you learned in this class, and what does our models that we learned up to now say about pricing of Bitcoin. Okay, and then of course I'll give my take on it, why I think it's mostly why you should treat Bitcoin as a commodity as opposed to an actual currency. And then, of course, I'll conclude, and that's it. All right. So let's talk about option hedging first. So options, we left off with describing what short, long, put, call looks like, right? And so now I'm supposed to demonstrate what these look like in conjunction with an asset or liability position. So I am going to again go through payoff tables and along with graphs, again, just to give you an idea of what we're actually trying to protect ourselves against, or what are we trying to be exposed to. So remember that as risk managers, we're trying to pinpoint the kind of exposure we want, whether we want upsides or downside, or complete elimination of certain fluctuation of the future assets. We can do it, but you just have to be clever with the design of your option portfolio holding. Okay, so let's see. So we're going to now analyze beginning with large drops. So large drops or large increases in value. So we'll start with large drops. So we're either going to buy a put or buy a call. So starting out with a asset position, let's think about protecting ourselves against a large drop in value. So large drop in value can be so the position that we have at hand is a long position in the asset. So again, we'll just do a payoff table to characterize our initial holding of the asset. Yeah, at time t. And as per last week, along with our discussion, as per last week, we're going to vary the states of the world. So in one state, we have the future value less than the strike price. In another state, in which the strike price is lower than the future value, and that will differentiate the type of payoff we get from the option contract. So if we are in a asset position, so we're going to pay for some assets, let's say it's today, and we're hoping that we can sell it at a higher value, right? So it doesn't matter which state of the world we are in, we're always going to realize ET, but we're just hoping ET is bigger than E underscore T. We can hedge against this drops in value here. If we take on a long put, so let me write long put here with a long put. What does a long put looks like? Long put means that we are paying for a put option at the beginning, so we have to pay P, so minus P. But our payoff is only triggered if the underlying asset falls below the strike, and therefore our payoff is K minus ET, right? Because we're hoping that uh, a put option tells us that we have the right, but not the obligation to sell an asset at time capital T for K, but we have to buy back to cover our position with a minus ET. So we're hoping that the buyback is going to be less in value than our strike price. And then, of course, in the case in which the option is not triggered, it's a zero payoff. So our final position, so let me draw a horizontal line to indicate that we're summing these two columns, is minus E underscore T minus P. So you realize that our initial payoff is negative. But if you look at these two rows, in the first column, the ETs go away. So we have just a K. And here we just have an ET. So because based on this payoff table, it's nice for us because we can see where the arbitrage, scenarios in which arbitrage cannot exist, right? So if this is negative, then these both can be negative. It doesn't make, otherwise it doesn't make any sense. But we know that since these values are positive and this is negative, then things are balancing out. You're paying for something, right? Depending on the payoff scenario. All right, so let's again look at these positions graphically. So we have three positions to consider. We have our initial position. So to make the graphing simpler, I'm going to assume the following. So just keep this in mind. Assume K equals E underscore T at the money for graphs. Okay, so that just means that when I buy the contract, the option contract, the strike of the contract is equal to E underscore T. Again, this is just for graphing purposes. The graph could look completely different, but just to show you again, to highlight what exactly you're exposing yourself to or hedging against. All right, so at the origin here, we have K, which is equal to E underscore T. And because we are unhedged here, hedged, okay, unhedged, our payoff therefore looks like this. Again, all I'm doing is plotting ET, right? No, the long put, K equals ET. The long put, its payoff only has value if where K is above ET or ET falls below the strike, in which case the payoff is K minus ET. So that means intercept K and downward sloping E. So it looks like this. So I'm just drawing that and then downward sloping. Okay, and then to the right of K, it's a zero payoff. If we add these two graphs together, you know that the downward sloping, upward sloping cancels out, and then it's just a shift of it's just the upward sloping on the right-hand side still. So our hedged position will look like the following. T K is equal to E. And then if we look at just the gross payoff and not factor in the payoff, when K is greater, or ET is less than K, so K is here, then we have a K. So that's up here. Just write K. It's positive. And then when ET is to the right of K, we have just ET. So it's just a upward sloping curve. But of course, we should probably factor in the cost, the upfront cost. So we notice that minus E lowercase t minus P is equal to minus K minus P. And if we're adding K, right, because that's this point here, then we're just left with minus P. So minus P is below the origin. So we'll probably be somewhere here, minus P. And then we still have this upward sloping curve. Right, because it's just a level shift, right? It's just a level shift downward. But again, now you know to which level it's shifting it to. All right, so what are we hedging? What are we exposed to? Based on this, we don't want to give up the upside. So you see that here, we have upside when there's large swings. So upside for large positive, I'll just write swing or increase, fine. Increase. We, however, have protection, right? Downside protection. The most you can lose, right? The most you can lose is minus P. And lose is minus P, right? And then, of course, small swings don't really help you. You don't make any money, but you're protected absolutely downside, but then you still have the upside. You retain the upside. All right, next. So I'm going to do this 3 more times. So this is just practice so that you get used to it. All right, so the other way, suppose you want to not give up the upside, but you want to protect against now large increases in value. So which means that you are of a liability position, and we're going to long a call. Payoff at time t, et underscore less than k, and k is less than et. Payoff at time t, if you have a liability, means that you sold something today. So let's just say you plus e underscore lowercase t, but then in the future you have to buy it back because you're hoping for your debt, for example, to be worth less. And so it's minus et and minus et throughout all states of the world. Now, if you are a long call, then that means that you paid for the call option. So it's minus CT or C. And the call option only pays off exercise if the underlying asset price exceeds K, which is a payoff of E underscore T minus K. And our final position is ET minus C, and then minus ET. And here we have minus K, right? So again, I like these tables because you can see the scenarios in which no arbitrage. So you can see that these are both negative, right? So this can't be negative, right? This can't a negative, negative, and this is also negative. That means you're paying to lose. It doesn't make any sense. So this needs to be positive. All right, so you can tell that this is going to shift our curve upwards, right? All right, so let's characterize hedged position, the long call, and also the hedged position. So Just like before, let's make this simplifying assumption for graphing. So assume that K equals E underscore T. That's the money for graphs. K is equal to ET. And this is the unhedged payoff, hedged. So we have a liability position. So that means that it's going to be a minus ET. So it's just a downward sloping curve for the origin. We have then our long call. We know what that looks like. That looks like this, right? 0 to the left of K and then upward sloping curve to the right of K with the intercept at K. And then our final hedged position. T. All right, so our main concern is this part. So E minus C is equal to K minus C, and then we minus K here. And so if we add everything together, it's just a minus C. But anyways, let me plot the gross first. So here we have minus K to the right. So right, minus K to the right. And then we have downward sloping curve to the left. And then we have still minus C, so shift it up a little bit. But still the same on the right. Okay, so we see that there's protection. So max loss is minus C. And then we get upside, right? Upside for large increase. Okay, and then small changes doesn't help. Or it does help, but it's not, you don't make money from it. All right. Questions, comments on payoff tables and graphing? So, all right, let's go through the small drops. So small drops, you're going to be selling a call or a put. So here, if you're hedging against small drops, you're long, and so you'll be, in this case, selling a call. Okay. Payoff at time t. E is less than K. K is less than t. So if we are long, we are minus underscore t, and then plus t plus et. If we are shorting a call, we will get the upfront price of the call option today, but we would have to pay out when it's triggered by our counterparty, in which case we have to pay minus E underscore T minus K, which is just equal to K minus ET. So our final payoff, our overall payoff structure looks like this. So let's add everything together. We have C minus ET, E underscore T, and then the ETs go away, so all we're left is K. Right, so what we should realize is that this is positive, this is positive, this can't also be positive, otherwise, that's arbitrage, right? It's free money. So it should be negative here. All right, so let us now look at the graphs. So unhedged. That's a bad UNHEDGT. And we're still going to assume EK equals that money for graphs. Okay. So this is ET, and then we have this line here. Then we have a short, in this case, short call. Then K is equal to E underscore T. And that will give us, let's see, so to the right, so to the left of K, we get 0. But to the right of K, we get an intercept at K and a downward sloping curve here. Okay, so this will cancel out with this, and so we're just talking about this still retains its shape over here. So if we looked at the hedge position, our gross without factoring the upfront payment is positive to the left. So upward sloping, to the left. So that is ET. Oh, sorry, let me write this. Is equal to ET. So sorry, let's look at the right first. Right is just K, so up here. That's K. And then we have upward sloping curve to the left. And if we're talking about adjustment for the upfront payment or upfront cost, then it's going to be a downward shift. And we see that C minus ET is the same as C minus K. And then we're adding a K. And so all we're left with this is a C, right? So C should be somewhere below, but it's okay because they're still positive, and the shape on the left side is still the same. Okay. So here we have max profit, right? At C of C, right? Your upside maximum benefit is capped. You get some protection, so you get some insurance. Insurance for small decreases. But your losses are, exposed to big losses. Big decrease. I just write arrow down. Okay, decreases. So I think the confusion probably lies here when you're shifting the graphs. So I think again, the direction of whether it's positive or negative is helpful to understand where it's shifting. And then because I'm making this assumption, right, you can easily see hopefully that the final intercept point on the y-axis must be what it is because terms cancel out. All right, and lastly, we have hedging against small increases in value. So we have a liability position, but we are going to sell a put, PUT, instead of a call. So liability is a plus upfront, right? But then you would have to buy it back at a cheaper price, ideally, in the future, in all states of the world. If you are short put, that means you get the put price upfront, but then you have to pay out to your counterparty when it's triggered, and that's when the asset value is below the strike, in which case you have to pay minus K minus ET, which is equal to K ET minus K. Let me move this over. Okay. And then otherwise nothing, right? Now let's sum everything up to see what our position looks like. So a plus sign. We have E. This is not okay. This one. Okay. ET plus P. So ET plus P. And then we have the E's go away, and then all we have is minus K. And then we have minus ET. So this is negative, which makes this positive, obviously. But now you understand that we're shifting the curve upwards, right? When we account for the initial cost. For these graphs, once again, assume K equals ET for simplicity. At the money. For graphs. So for the unhedged position, sorry, unhedged position, we have here just a downward sloping curve, right? Everywhere. So that's T for the short put. So short put. Short put says 0 in the case in which ET exceeds K. K is here. And this is ET. So 0 to the right. Here. There. Okay. And then we have intercept K, but a positive sloping line to the left. So it's like this. It's like this. Yes. And then we can add it all together. So our hedged position. You can kind of see what's going to happen. This will cancel out with this for a flat line, but this still will retain its shape. So still here, K equals T, capital T. So to the left of K, we get a minus K. So that's down here, minus K. That's just this flat line here. And then to the right of K, we have a downward sloping curve. But to account for the initial price that we get for selling the option, we have ET plus P, and then realizing that K is replaced. You're replacing ET, and then we have the minus K, so the K's go away. So the final intercept is going to be P, so it's going to be somewhere here. And then everything else, the shape is still the same. Okay, so here, right, we see max profit at P. And then you get some protection for small increases. Small positive. I'm going to use the arrow for increase. And then, but of course, you're exposed to large increases. All right. You guys get the idea now to, if I told you if you're hedging with more than just one option now at different strike prices, you know how to walk through the steps right. So for example, if I gave you two options with different strike prices, then you have to think about every possible states of the world, right? If the price falls below one strike price, falls between two strike prices, falls above a strike price, you can characterize the payoff structure for each of the positions plus option, and then sum everything up to get a final payoff structure. And then now you have an idea of how to plot it, right? To think about the intercepts, think about slopes of the curves, and then you can visualize, pinpoint exactly what you want to be exposed to, right? You want the upside, you want the downside, you want protection, you want to cap your profits, you want protection for small increases, whatever. Okay, or do you, in some cases, with combinations of options, you can get very exotic bets. Okay. All right. Comments, questions on this is like risk management tools, right? So you understand the option contract, you understand how to write out these payoff tables, you know how to draw these graphs, so now you know how to make presentations to your bosses. You know, this is what we want to protect ourselves against, blah blah blah. Okay. All right, so these are just summaries, the pros and cons of various positions. So of course, buy assets, sell assets. I think you know what those risks are: unlimited upside, unlimited downside, blah blah blah. Call depending if you buy put or buy call, you saw that you had to pay a premium upfront, but you don't give up the upside. But if you sell put or sell call, you eliminate those upside, but at least you retain the premium upfront, right? That's kind of what you saw. That's the summary. So I'll leave it to you to review by yourself rather than reading it to you here. All right, so let's talk about pricing. Okay. So pricing is is different, okay? And so I think before talking about exactly pricing, I have to give you an idea. I mean, before deriving, big picture idea of how to price things, let me just first talk about what should influence the price of these options. I think once you have an idea of what influences it, then you have an expectation of what you should see in the option pricing formula, right? So Greeks is a term to refer to the sensitivity of the option price when certain parameters of the option price formula changes. Okay, so let me say that again. Greeks is a reference to different sensitivities of the option price when certain parameters change by a little bit or a unit change. Okay, once you understand what parameters change and how it impacts the option price, then I think once you see the option formula, it should make total sense to you. So remember, I'm not trying to give you explicit formulas of these sensitivities. I'm just trying to walk you through how to think about intuitively why these values should change in response to changes in various inputs in the pricing formula. So in this table on slide 22, I have a table in which I increase different parameters of the option pricing formula. So as you can see, there's the underlying asset price, right? If the currency value changes up or down, how does that change the option price? How does exercise price change, etc.? So what I'm going to do is walk through each row and then tell you how the option value, whether it's a call or a put, also changes in which direction. Again, this is supposed to give you an idea, a sense of how to think about what should impact option prices. So when you see me derive it, so to speak, it won't be you should you should expect to see something in the formula eventually. All right, so to clarify what should change, I think it's helpful to write out the payoff function of these option contracts first. So a call option is ET minus K, right? It's a max function of the asset price minus the strike price and then zero. So, and then the put is the mirror image, right? You're going the other direction. You're hoping the asset price falls. You have the right, but not the obligation to sell at K, but then you have to buy back at E capital T. And otherwise you don't exercise at all, right? So it's a max function. So look at these various increases. So when I say an increase in asset price, what I'm talking about is the following. So how does the call option price change if I change ET, right? This is what I'm talking about here. So I'm not gonna write this for everything, but just telling you this is what I'm looking at. I'm looking at how the option price changes, in this case, call option changes, when the underlying asset price change. You can see which direction it changes by just looking at the formula of the payoff function, right? So for an option, if the underlying asset price gets bigger while everything else stays the same, namely the strike price, then the payoff gets bigger, right? And so that means that the sensitivity of the call option, given that the asset price changed by 1 unit, is going to be positive, right? So let me just write a positive sign here, but this is what I'm referring to, right? That the sensitivity is positive when there's a unit increase in the asset price. For the put option, again, same idea. We look at the payout function. We realize that if the asset price gets bigger, the minus sign gets more negative, and k minus something that's more negative is going to decrease. That means my value, the money I can retain after exercising is smaller. And so the sensitivity of the put price with respect to a change in E is bad for us. It's going to be negative. So I'm going to write a negative sign here. Okay. So these are called Greeks because we have names for each of these sensitivities. So this is delta. This is called delta, and the Greek letter delta. So you may have heard delta hedging. What are they hedging against? This is exactly what they're hedging against, right? Okay, so that's delta. Exercise price. Exercise price is also in the payoff function. It's here. So when there's an increase in the exercise price for a call option, that makes this minus sign more negative, which means this undermines our payoff. And so we should expect a negative relationship, right, between the call option price and the exercise price. For the put option, it's the opposite, right? K is in front, and if we have a larger K, the more payoff we get, the higher value we can get for selling the underlying asset, and so our payoff is greater, therefore it's positive. As far as I can know, there's no Greek letter for this, but for the next one, it's also quite famous. This is called Vega. That's not a Greek letter, just letting you know. Vega is not a Greek letter, but they use V to indicate, so V, a cursive V, to indicate volatility. So this is volatility with reference to the underlying asset. So let me be more precise. We're talking about this sigma square root of the variance of E, right? That's what we're looking at. That's the volatility. So the intuition is not clear here, right? You can't determine this based on the payoff function, but we just have to think about it logically, okay? So given a fixed amount of time, if the underlying asset is more volatile, we intuitively think that there should be a higher chance now that if the option is out of the money, there's now a higher chance that it could be in the money, right? And so higher volatility assets should increase both the value of call and put options. So let me say that again. Given the same amount of time, so fixed time, so let's say within 1 year, within 10 years, if the underlying asset is more volatile, then there's a higher chance that the option contract will be in the money. Meaning that if I hypothetically could exercise it sometime between time 0 and time capital T, I could get some money. That's the intuition. So this is true whether it's the call option or the put option because volatility is thought to be symmetric, right? You swing left and right equally, right? So we should see that the option price should increase in value for both put and call. All right. Interest rate. This is referred to rho. So this is the cursive P. The way to think about row is to think about call options like a version of futures slash forward contracts, right? Option contracts, again, it's a right, but not the obligation to buy something or to sell something for put. Futures forwards are the same thing, but it's an obligation, right? It's not just a right anymore. You're obligated to deliver or to buy. But our description of the cost of carry still applies, right? So if the cost of carry argument still applies for call options and put options, then higher cost of carry will be transferred to uh, the long position, right? The call position. And so if it's more expensive to deliver the underlying asset at to maturity, the the short position is going to, transfer those costs to the long position, and therefore the long price is going to be higher. And so the call option price, therefore, is going to increase for higher interest rates. So interest rate is the cost of borrowing, which is contributes to the cost of carry, right? So review last week's slides when we talked about our futures and forwards, right? We had that cost of carry formula. It's like R minus D, right? Plus S and then minus C. So that's just the first part, the R. So we have higher R, higher interest rate, higher borrowing costs, higher cost of carry, and so the call option price is more expensive because the short side is basically transferring those cost of carry costs to the long position. All right, and then it's the opposite for put, right? Because the cost of carry eats away at your put price, right? Time until expiration is theta, and that's the capital T, right? The argument for theta and volatility is the same, essentially, right? Because Vega says fixed time, higher volatility, more likely to be in the money. Time expiration says that, okay, if I give you fixed volatility, but I expand the time, increase the time to maturity, then now there's also higher likelihood that you could be in the money. So time to expiration also helps the price. So positive and positive. And lastly, this is foreign interest rates. This is the new thing that you probably didn't see in your option class, but now it's here. And again, the way to think about this is to think about it from the perspective of cost of carry. So let me write these 2 points. C cost of carry, right? It's the cost of carry argument. So here, if it's very, very convenient to carry the underlying asset, such as there's interest payments, right, from the underlying asset, then that's going to come out from the delivery price, right? Come out from the asset price. And therefore the long position is going to pay less for it, right? Because they're not going to be paying for those dividend payments, for those cash emissions. So it's a minus. But those benefits are going to be reflected in the put price. So therefore it's positive here. So again, think about the cost of carry. This is a negative effect on the cost of carry. This is a positive effect on the cost of carry. So if you increase the cost of carry, it's going to make the call position more expensive. If there's a lot of benefits, it's going to make the cost of carry even less, and therefore the call options even less. And then we get the reverse effects for the put, right? Because they're the other side. All right. Comments, questions. So these are the primary inputs of options price formula. And so what you should be asking is um, how come there's no like beta here, right? We didn't talk about beta. We didn't talk about expected value of the underlying price either. So that doesn't matter either. So now I have to explain to you why those things don't appear in the option pricing formula. So I'm gonna walk through option pricing valuation, just a very higher level explanation. So meaning that I'm not gonna go into rigorous proof here. This is just a review for those of you who have exposure, but for those who don't, I'm gonna try to bring you up to speed, but then again, it's just a shallow understanding of what's going on. So let me bring it up to the other slide here because that's where I explain the difference between option pricing and other types of pricing. All right. So the option pricing formula is famous because it won a Nobel Prize. The inventors or several inventors that were trying to prove the Black-Scholes formula, they won the Nobel Prize for it. And as I said, the math is very advanced, but it doesn't need to be, as subsequent people found a different way to prove it. Um, but the complicated math is not, is not superfluous. It's necessary because the way options work is very different to price, those traditional classical assets that you know about, like stocks and bonds, and also futures. The fundamental difference between options and those assets is that the returns scale linearly and are symmetric, right? So if you lose something, it's current price minus previous price, right? That's your return. And but for options, it's not that way at all, right? Because there is a contingent claim, right? The payoff is contingent, and therefore your risk is not linear or symmetric, right? There's not necessarily an upside downside. There's some hedging going on here too, right? And so the payoff there, the hedging, I mean, the discontinuity, right, and your payoff comes from the fact that your payoff is only triggered if if the underlying asset exceeds or falls below some threshold, right? So it's contingent on those states of the world. And these features that I just talked about, right, this non-symmetric, non-linear payoff is not captured by CAPM. Okay, so remember what CAPM is. It's a general asset pricing formula, assuming that there's a trade-off, linear trade-off between risk and return, right? So everything can be priced with that exposure to that one single risk factor. But of course, options don't scale linearly. They're non-linear payoffs, and therefore it's wrong to use CAPM to price options. You're not matching reality with the math. Okay, so we need an entire different mathematics to deal with this. So, so what I'm saying is that you can't use the DCF method for option pricing. Okay, the DCF method assumes linear exposure to risk, right? CAPM is expected returns equals to exposure to beta. That doesn't make sense because DCF is just one discount factor, right? Just one discount rate. Whereas options, if you want to be as close to reality as possible, you need different discount rates for different states of the world, right? You need an up version discount rate and a down version, right? A bad state and a good state discount rate in the most simplistic terms. If you do apply DCF to option pricing, you're basically assuming there's an average discount rate. Again, this is not accurate. Okay, this is not reflective of the real world. And so you need to come up with a better model that allows us to model these states of the world, right? Above a threshold or below a threshold or whatever. Okay. And the insight from the Black-Scholes formula and its proof is that if you can identify so-called risk neutral probabilities, which I'll talk about soon, but just remember this phrase, risk neutral probabilities. If you can identify these things are in fact the discount rates for different states of the world. So this is equivalent to different discount rates for different states, for different states. All right. So I hope that's a proper motivation of thinking about option pricing. Okay, can't use CAPM. It's not an exposure to. You can't price it with how exposed they are to beta in the market risk factor or some linear combination risk factor, because the payoff structure is nonlinear, right? It depends on the state of the different states of the world, and therefore you can't use DCF to price options. You need a different set of mathematics in order to capture this up and down states or just different states to get different discount rates to discount different cash flows under different worlds, different like heads or tails worlds, right? Okay, so let me just go over a simple binary tree model to show you what I mean by different states of the world and what I mean by risk neutral probabilities, right? So this is how we typically price options. Uh, a model option pricing. Okay, so let's go to valuation. In the most in the most basic model in which we try to incorporate different states of the world, we can just assume that states just diverge in binary cases, meaning just up or down, one or zero, right? That's the easiest way to imagine different states uh, without thinking about, spectrum, right? So let's look at a binomial model in which there are two states of the world. And to keep our lives simple, let's also assume there's only two types of assets, a risk-free asset and a risky asset, right? So this is simplify, make our lives easier. And let's just assume that the likelihood of a bad state or a good state is 50-50, but you will soon realize this to price options, the real world probabilities don't matter, right? This number doesn't matter. But in any case, let's assume that's true. So let's assume the price of the risky and riskless asset are both at 100. There's two states of the world. Let's talk about the risky assets first. So $100 asset, risky asset can go up or down, 50% chance, coin flip. It can increase up to 120. Okay, so that's just a 20% increase, right? So I'll write a plus sign here. Or it can decrease to 90, so this is a minus 10%. I'm just making these numbers up, okay? This is for demonstration purposes. This is the risky asset. You can think of it as a bond, I mean a stock, which is fine. Now, the riskless asset, as it sounds, you get the same payoff in all different states. So there's two states, again, 50-50. And the payoff therefore is, let's just say it's 110 in all states. What that means is that there's a 10% increase for sure if you hold on to this riskless asset. This is riskless. All right, you guys get the setting here? So two different assets, two states of the world. For the sake of demonstration, just to make things clear, let's just assume 50-50. Okay, risky asset, 20% chance going up, good state, negative, and then 50% chance going bad state, minus 10%. And then the risk list pays the same no matter which state we are in, is always 10% increase. And now let's think about an option contract, a call option contract. The question now is, what is the price of C given two different states? So we know C, its payoff, right, depending on the state, is the risky stock, 120 minus K, which is equal to 100. So 100, 0. This is equal to 20, right? That's what the call option price is, right? It's just the actual price that you see in the future, the good state, that's 120 minus the strike price, so you get 20. Whereas in the bad state, it's 90 minus 100, right? Otherwise, it's zero. And in fact, you do not exercise, right? And just for the sake demonstration, it's two states of the world, heads or tails. Now, the question is the price of the call option simply just 50-50, weighting these 50-50 by the payoff of 20 and 0? Is it just 10? Well, the dead giveaway why this is wrong is where is the discount rate, right? Well, this tells you the average of between 20 and 0 given 50-50, but we haven't found a way to discount it to times 0 because that's what C is, right? C is a discounted value. You have to discount all payoffs from the future back to times 0. We haven't done that. Where is the discount rate? Right. So this is clearly it looks close to being true, but of course it's not absolutely true because the price has to somehow incorporate a discount rate, and we don't see it right here. We're just waiting the payoffs, the price, the payoff of the call option in the future, but as we haven't moved from the future back to time 0, right? That's the problem here. So we need to think a little bit more sophisticatedly, okay? Um, so what we're going to try to do is we're going to try to form a portfolio of risky and riskless asset to mimic this payoff structure. So just like bootstrapping bonds, right? We use portfolio of bonds to mimic like a zero coupon bond. We're going to do the same thing here. This relies, of course, on the law of one price, right? If we can mimic the payoff, then the portfolio that we construct from the risky asset should be the price of the call option. Right, so let's try to do that. Let's try to mimic this payoff function by holding a portfolio of risky and riskless assets. And we can characterize this portfolio in the following way. We have two equations. The first equation has a payoff, tells us that on the left side, a payoff of 20, right? That's the good state. So write good here. Good state. In the good state, we are holding X amount of risky stocks and Y amount of riskless so risky asset and a riskless asset, right? So X and Y is quantity times the price of the asset, risky asset, and the riskless asset. In the bad state, we have another equation, 0 payoff, but we're also holding this same amount, XY, of risky asset and riskless asset. So do you see what I'm doing here? I'm trying to find the portfolio holdings that, given the evolution of time, it will mimic the payoff of my option, right? To get 20 and 0. So all I'm doing is solving for the portfolio weights. Make sense? So you can do this yourself mathematically. You can do linear algebra if you want, or you can solve for x and then solve for y. So I'll give you some hints. So I think x is equal to 110 y over minus 90, right? And you just plug in x into one of these equations, right? And then y is going to be equal to like 20 over 120 10 over negative 90. Anyways, you know what I'm doing here, I hope. You're just solving for x, plugging in x into another equation, solve for y, and you should get the following expression. All right. So one key intuition that comes about from solving these weights is that you get a negative sign here. So what does that tell you? That tells you that call options are leveraged positions. That's why it's different from futures, right? And all the other stuff. The option, the contract itself is leverage. It's as if you're borrowing something and then going long on stock. Okay, that's number one. Number two, you take these weights, you plug it into the price of the risky asset and riskless asset at time equals 0. You should get the value of your portfolio at contract initiation, right? So 2/3 times 100 minus 6/11. So this is risky, right? Risky, and this is riskless. You should get the value of your portfolio that replicates the payoff structure of the call option. And you can see that it's not 10, right? It's not equal to 10. So this is actually the price of the call option. Okay. Cool. So what have we done? What we have done is we have constructed a replicating portfolio that mimics this nonlinear payoff structure of this call option. That's what we have done. We have constructed a portfolio holding some amount of X, some amount of Y, such that over 2 periods, it gives us the exact same payoff structure of a call option. Given those weights, we can therefore derive the price of that portfolio at time 0, which will tell us that the price of the call option, of course, assuming that no arbitrage, right? Law of one price. All right, so that's the basic of option pricing. So when you do option pricing in terms of Black-Scholes or whatever, this is exactly what they're doing. They're creating a replicating portfolio to mimic the payoff structure of the call option, and then they try to, and then they solve, and then they can solve for the price. But based on this, it's not doesn't tell you too much about the intuition, right? So we want to know the discount rate. What's the magic behind this, right? What's the magic? So let's go ahead and try to generalize this formula so that we can see the discount rate at least, or what's the risk neutral probabilities, right? What's the different discount rates for different states of the world? All right, so we can do that. In fact, let's go ahead and generalize this setting so that we won't specify exactly the good state, bad state, increase, decrease in value. We'll just use a general percentage, okay, of return. And same with the riskless asset. And we're still going to assume it's 50-50, but you'll soon realize that this doesn't matter, okay? What's the distribution of the state of the world doesn't matter in terms of its option pricing. All right, so let's generalize this a little bit. So for the risky asset, let's assume that it can increase by 1 plus U. So U is the up return, okay? Or it can decrease or increase less by 1 plus D, okay? D could be negative, could be positive, could be a positive number lower than U, but we're generalizing, okay? For the riskless asset, still value of 100, and it's going to be a fixed return, R. So no matter which state of the world, you get R percent, right? So 50-50, 50%, 50%, percent. All right, so get it? So all I did is replace 20% and minus 10% with U and D and replace 10% with R. That's all I did, okay? Now, we know that this is wrong, right? The price of the call option is not 50-50. The call payoff of up scenario of the call option plus 50% of the down scenario for the call option. That's wrong, right? So what we want is to, again, calculate a replicating portfolio that mimics the payoff of CU and CD in different states. and solve for C naught, right? The call option. So just like the previous, we've replaced the CU and CD. It was 20 and 0. Now it's just a generic placeholder, CU and CD, whatever it is. So what this tells you, right, is that it doesn't have to be a call option. It can be anything. It can be any nonlinear contract, or even a linear contract, doesn't matter. This is a general asset pricing method, right? I didn't, here is just a generic up and a generic down. I didn't tell you it's a max function, right? So it doesn't have to be. All right, so CU, so this is the good state. The good state, I'm holding a riskless asset, so risky asset and riskless asset, so that's X and Y. If it's risky, I get U%, 1 plus U%. If it's riskless, I get 1 plus R%. For the down state, the bad state, still CD, 1 plus D in the down state, bad state, and then for the risky asset, but I still get R for the riskless asset. So I'm solving for X and Y. Two equations, two unknowns, one unique solution, right? Two equations, two unknowns, unique solution. Solution. Right? So the math gets a little bit messy, so I'm going to skip over the derivation, but let me just tell you what the solution is. You should confirm for yourself, okay? This is the solution for a two-period binomial tree model. I mean, of course, you can extend the tree even further, right? You can imagine it gets quite complicated, but just for demonstration purposes, just assume for two periods. This is X, this is Y. To get the price of the option, remember the price of the option, both risky assets and riskless asset is just $100, right? So we can just sum X and Y for simplicity and just remember that it's multiplied by 100. We can start to see the insight, right, of this option pricing method. Here is the discount rate right here. Pretty neat, right? So the discount rate is just the risk-free rate. But we get some interesting rates here. What's this and what's this? These are called risk neutral probabilities. Why? Because they not only sum to 1, all right, that's number 1, but they allow us to use the risk-free rate as the discount rate, right? So you remember what risk neutral means. It means that you ignore risk, right? And so basically what that means from the risk neutral investor, the returns on all assets is basically the same, right? Because you're ignoring risk. Make sense? So after you weight the risk neutral probabilities to the payoff of the call option, then I can just simply use the the risk-free rate to discount these cash flows back to time zero. Okay. Now you can also start to see where volatility starts to matter, right? How do you look at volatility in this mathematical formula? Look at U and you look at D, right? U and D is kind of the difference, right? It's supposed to be a measure, a way to see how wide the asset price swings left and right or up and down. So if U gets bigger, option price gets bigger. If D gets lower, option price gets bigger, right? So you can see the volatility matters here. All right, so now since each of these parameters, right, correspond to a different state, these therefore expressions refer therefore to the state dependent discount rate, right? So it's the same as state discount rate. So we found it. So by identifying the risk neutral probability, we found different discount rates for different states of the world. Right? And so once you weight appropriately for those different states of the world, a good state and bad state, we're risk neutral now. We can just discount everything by the risk-free rate. Done. So I want to prove to you, show you with actual numbers that you are indeed risk neutral. So how do I show you that you are risk neutral given these P's? Let's go ahead and plug in those numbers that we did before, right? So we had what, 0.1 for R before, right? Minus, minus 0.1, right? We had 10%, and then we had a downstate decrease of negative 10%. We have an upstate increase return of 0.2, and then we minus the downstate, which is 0.1. That gives us a discount rate or risk neutral probability P equal to 2/3. So 2/3 and 1/3. Right? Remember, I told you these expressions sum to 1, right? All right, so with 2/3, we can go ahead and calculate the price of the risky stock, right? A risky asset. So 2/3, 120 plus 1/3, 90, right? Downstate, bad state, upstate, good state, bad state, discounted back to time 0. So 1/1 plus 0.1, right? The riskless interest rate. That will give us, check your calculator, 100. Okay. For the riskless asset, you do the same. Discount by the risk-free rate, also 2/3, 110 plus 1/3, 110, which is just, the whole thing is just 110, right? You also find that it's 100. So we have proven that you are in fact risk neutral, right? Assuming that we use these probabilities. All right, so this is the general derivation, of course, but hopefully this numerical example convinces you, right, that you value both of these assets the same way, right, using this risk neutral probability, because it makes you ignore, these probabilities make you ignore risk. Okay. All righty. So you saw the volatility terms, right? That's UR minus DR. And again, the key idea to prove option pricing is through this replication of the portfolio that mimics, right, the payoff structure of the call option. All right, so so you have the insight now, right? So you have to do this state modeling in order to get a way to properly price options. But of course, there's other takeaways. So let me go to that. All right. Oops, wrong one. Okay, so once we recover the risk neutral probabilities, right? We have therefore value nonlinear risk exposure because we have different discount rates for different states of the world. Okay, and the interesting takeaway, right, is that real world probabilities do not matter anymore, right? When we do this, I don't care how the real world price evolves. It's not necessary to use to price options. Okay. And so with the real world, with the risk neutral probabilities, we can use those to therefore write an explicit formula for the call option price. So remember what the math looks like to price actual call options, right? It's supposed to be the real world probabilities, but you can also do the same with now Q. That means the risk neutral probabilities. So as long as we have the risk neutral probabilities for those different states, we can calculate the price of the call option in this manner, right? This is all we need. Okay. And using those Qs, once we identify those probabilities, you get this formula, which you've seen hopefully many, many times already. Okay, and you can already see the leverageness, right? You can see the leverageness of this formula. Here's your exposure to the risky asset. Here is your leverage, minus K, right? The only difference now is there's this minus RD, but the way to think about this minus RD is through cash emissions of interest payments from uh, depositing your foreign currency in a foreign bank account, right? That's the difference here. So let me highlight the remarkableness of this formula. Beta is irrelevant. There's no calculation or expression that represents expected returns. That also doesn't matter. We don't care about expected returns here. There's also no drift probability, so there's no change in average value either. The only thing that matters is volatility, right? That's the only parameter that matters here. That is here, right? Here and here and here. Okay. So of course the Black-Scholes model is simplistic because it assumes volatility is constant. That's obviously not going to be true. And if you plot the implied volatility, so implied volatility is so given this formula, you can plug in price, plug in all the parameters, and then try to back out the sigma, right? That's what implied probability is. Given the price, given all the other parameter inputs, you can back out sigma. The sigma will not be constant. Will not be constant as you vary strike price, right? So you may have seen the phrase volatility smile. The smile tells you that we're not in a Black-Scholes world. Sigma does change based on different strikes. Okay. So the model I showed you before, it does generalize to Black-Scholes, but you have to take n to infinity, and the proof is in this book. So it's beyond this course, but for those of you who want to know how it's proved, it's here. Okay. All righty. Let's see, is that it? All right. Okay. So last thing I want to highlight is that we have the different term that you should pay attention to is this R, interest rate. And is there a foreign interest rate? Yes. So interest rate, but then F and D. Okay. So this is the Black-Scholes formula for currency options. So F is foreign and D is domestic. So F here again is like some sort of benefit. So you can again think of this from the cost of carry, right? And this is the cost. This is also cost of carry, but it's for borrowing, right? This is borrowing cost. These are the same. Sorry. This is the same, right? These things. So one's a benefit, one's a cost, and they're going to have different effects on your option price. So if it's a benefit, it should deflate your asset. If it's a cost, it should increase, right? All right. So this stuff, I think you've seen before, so I'll leave it there. I'm not gonna test you on this, but just in case, everything else goes through. So put call parity, etc. All right, so that's it for options. Do you have questions for me? Or all right, so maybe I spend the next 10 minutes talking about um applications. All right, and then we'll take a 10-minute break. So we can combine options and futures to extract investor beliefs about the distribution of future prices. And this is something you can see on Bloomberg, but you would have to, dig for it, I guess, type it out, ask for it. But here I'm supposed to tell you how it works, at least a simplified version of how it works. So let me explain to you the goal here. The goal here is to use option prices on futures. Okay. So option prices on futures in conjunction with the strike price to derive a distribution of what investors think the price will be in the future. So here we have strike price 1, strike price 2, strike price 3, etc. But we can get, a likelihood, back out some likelihood distribution for what investors believe uh, the price will be, for example, 3 months from today, right? Something like that. Okay, so we're trying to find out what investors believe about the future price. Why is this? So where is this used mostly? This is used mostly when we're trying to forecast interest rate path. So uh, there's a futures market for everything. And one of the major futures market besides currency is interest rates too. So people make bets on what the future interest rates will be based on what, for example, the target rate that the central bank sets, right? So for the US, I believe central bank, Federal Reserve target. This is the upper rate. Okay, upper rate's fine. All right. So right now the rate is 4.5, but as you can imagine, in terms of beliefs, there's always a distribution around 4.5, right? So people will issue forward and futures contracts around this. So uh, sometimes the futures contract is 4.5, sometimes futures contract is 4.75, whatever. Then and then there's options on these futures contracts, right? And therefore that allows us to kind of get a distribution of the beliefs of investors around what the Fed will do, what the central bank will do. So that's what it's primarily used for. But of course, we can do the same thing for exchange rates too. Options on FX futures. All right, so let me give you the settings. So suppose we're in April and we're trying to forecast what the market believes the price of euros in terms of dollars will be in June. Okay, so we're looking at euro currency futures in terms of dollar prices, but then we're looking at options on those futures that will settle in June as of April. Make sense? Yes, I'm gonna say that again. We're trying to characterize what investors believe about the future price of euros in June. So we're looking at futures prices. But then to get the distribution, we're going to use options on those futures to back out the density of around the price of the prices of those option contracts. Sorry, price of the cost of euros in terms of dollars using those option contracts. So the intuition here is that the strike price will give us the set of possible outcomes. That's this x-axis, right? The strikes will give us the set of possible outcomes, and the option payoffs and the price will give us the weights. That's these bars. So how do you do this, right? How do you do this? All right, so you start out with a fairly simple model, but something we don't see, cannot observe. So let me tell you what this is. This is the price of the option contract, which is the expectation of the payoff of the option. That's what capital P is, the payoff of the option, times the discount rate. We don't know what this is, right? We don't see this. So if you want to write this into a discrete format, meaning that suppose that we can just sum up the weighted average based on the likelihood of these different states of the world, we can. Suppose there's J states. Of course, I made this up. J, of course, can correspond. J corresponds to the number of strikes, for example, right? And we weight each of these discount factor adjusted payoff of options by pi. All right, so we don't observe pi and we don't observe m, right? But we can certainly calculate the payoff of an option contract P because that's just a max function, right? Max dot 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 0, depending on your put or call, doesn't matter. And we need to make some adjustments to to pinpoint exactly what exactly we're solving for eventually, okay? So let's just try to compute a risk neutral probability variable here. So I'm going to use pi tilde to represent this risk neutral probability. And we're going to scale the real world probability times the discount factor by the sum, the weighted sum of the discount factors according to different states of the world. Okay. So what we are actually subbing for is this, but we're going to simplify our assumption by saying that, maybe this risk neutral probability is approximately equal to the real world probability. Okay. That's our hope, right? So let's try to combine the pi and m together by scaling this whole thing by the sum of the weighted average of the discount rates. Okay. And therefore so this one should be small p, sorry. And therefore our equation just will look like this. Right, remember once we are working with the risk neutral state, we're just using the risk neutral discount rate, interest rate as the discount rate. And then we have to take expectation in the risk neutral, using risk neutral probabilities, right? This is what we're working with. So anyways, all this stuff here is what we're doing is we're just scaling, okay? We're adjusting the real world probability so that we get this fake probability so that we can just think about risk neutral probabilities. All right, so as you can imagine, we already made lots of assumptions. We're going to assume that investors are risk neutral, and so when we're just solving for pi tilde, we're actually solving for pi. Okay, and we'll talk about how to solve for it soon. The discount rate will be approximately equal to 1 because over short periods, such as from April to June, right? That's just 2 months. We can just assume that the interest rate, the risk-free interest rate is just close to 0. Okay, so we just assume it's equal to 1. And so for the price of the payoff of the option is therefore just the following, right? If it's a call, it's max E minus K. If it's a put, it's K minus S. But note that we're using real world probabilities here because we're assuming that the risk neutral probability is equal to the real world probability. So we can solve for this, right? We want to solve for this. And we can. Why? Because we can rewrite everything in terms of matrix form. So P here is the price of the options we observe, option price. This is the payoff matrix at maturity. So that means that for different strikes, so here we have, so the column here, different states, different strike. I'll just write different strikes or different states. And this is different strikes. Different strikes. Make sense? So all we're doing is going through different states of the world, right? And then see what the payoff is depending on the option strike value. And that should yield a payoff, right? For the option at maturity. All right, so you may have noticed that there is a row of ones here, right? Here's a row of ones. The trick here is that the sum of the probabilities, we want to make sure the sum of the probabilities that we're trying to solve equals to 1. Make sense? So that's why we put a row of ones in the P. All right, so once we've written everything in this format, we want to solve for this. Solve for this. And you can already tell what P times pi is doing. P times pi is is weighting the different states and different payoffs, right? And adding it together, right? And we're weighting the sum of the payoffs over different states, right? That's what P and pi. We're going row times column. This is matrix multiplication, okay? So if you don't know what that is, I can explain it to you after during the break, but otherwise that's what we're doing. To back out pi, you multiply both sides by the inverse of P. Okay, and that's it. Okay, very simple. So let me give you a numerical example here. So suppose you have the following strike prices for these call options, and this is price here. This is price. Different prices, different strikes. So this is the P matrix. Okay. I'm sorry, P vector. This is the capital P matrix. So different strikes, right? And different states of the world. Different states, different state. This is different strikes. Strikes. Let me type it out then. And so you can see P times capital P times pi. All we're doing is going 0 times pi 1, different pi 1, 0 times 5 times pi 2, 10 times pi 3, etc., right? Must be equal to the price, this one, right? And so forth. Weight the different payoffs multiplied by the likelihood should equal to the price. And the last row, we're just summing pi 1, pi 2, pi 3, pi 4. And then, so the final P vector should have a last column of entry of 1 because we're making sure that the probabilities are summing to 1. Okay. So we have P times pi, and then just inverse the P. This is what you get. Okay. So here we have a characterization of the different states of the world, 70, 75, 80, 85, 90. Then we get a likelihood for each of those payoffs. Right? So you can get this information from Bloomberg. You can pull it up. They do this exact calculation. Maybe they have some, of course, smoothing function to make sure the density is not just discrete but smooth. But the idea is the same, right? You have to make the assumption, of course, there's many assumptions. You have to assume that investors are risk neutral. And if they're risk neutral, that means that the weights that they solve for will tend to overweight bad states and underweight good states because they're risk neutral. They don't care about risk as much, right? So bad states are more weighted than good states. Um, and there's also scenarios where you get redundant assets, right? So if you have put in call options with the same strike prices, for example, right? You should just choose one. It doesn't matter. Just choose one of them. And that should shrink the states of the world to a unique set of states of the world. Okay, so that's it for option pricing and futures. So I hope that was helpful uh, or interesting to some extent. So let's take a 10-minute break and then we'll talk about current cryptocurrencies a little bit. All right. So if you haven't signed into the attendance sheet, please sign in and then let's talk in 10 minutes.
Oh, oh.
So the final topic of this course is on Bitcoin. All right, so let me first premise this discussion on why you should care about learning about Bitcoin. I realize that most of you are perhaps from mainland China, and cryptocurrencies is pretty much banned or outlawed. But I imagine if you want access to this currency, it shouldn't be too difficult because you can use various ways to overcome these the firewall. And if you really want access to that wide range of digital currencies, is easy to get, especially in Hong Kong nowadays. So Hong Kong is positioning itself as a gateway to access crypto assets, digital assets. And so, in fact, many ETFs are already being traded on the HK stock exchange, right? I think there's a Bitcoin ETF. I think there may be Ethereum ETF. It is already being traded or soon to be. But that's one reason that you should pay attention is because financial centers like Hong Kong, digital assets is being taken seriously, and therefore you should educate yourself. Okay. Other reasons why you should pay attention to Bitcoin and other cryptocurrencies is because digital assets and blockchain technology is a topic that will be tested on certification exams such as the CFA. So I believe this started in 2019, so I had to introduce it a little bit to my classes, so I'm continuing to do this. And so if you're planning to, take these exams, you need to pay attention to blockchain/digital assets. Okay, so beyond these two reasons, like if you're not going into the finance industry in Hong Kong or you're not taking the CFA exam, uh, maybe you're working for a company and maybe you're looking for a central bank. Uh, well, blockchain and other digital assets which rely on the blockchain does help you track things, okay? Specifically assets or more precisely currency. So there are several central banks that are investigating ways to track money in circulation using the blockchain. Of course, it's not a unique way to do it, but it is one way to do it in a decentralized manner. And if you don't understand what decentralized means, it will be very clear to you once I show you the video that explains it, okay? Number two, as I said, beyond the central banks, companies may be interested in, for example, tracking stocks. So right now, it's very difficult to figure out who owns what stocks, actually. Many people kind of outsource ownership to custodians, such as mutual funds, hedge funds, and they vote on your behalf, even though they're not the ultimate owner. But if you have blockchain technology, you can know when these stocks are being, given to somebody else, lent to, etc. And so there's more transparency. And so that's another way blockchain can be useful for those who are asking for why blockchain and why not something else. All right. So if not those three reasons, then if you're interested in like the primary markets such as IPO and VC industry, then maybe cryptocurrency can be thought of a way to raise financing. So this was big in 2017, but we all found out that most of the companies that were doing what's called initial coin offerings were scams, right? I don't know. Nowadays, I think there were still a few handful that were legitimate. I think Ethereum was a legitimate ICO, but most of the other ones were not. But nowadays, I think what they try to do is they will issue out currencies beforehand, and insiders can liquidate their positions once these coins get listed on certain exchanges. So sometimes initial exchange offerings is another way to raise capital. Uh, all right, so the difference, of course, ICOs it's like IPOs, right? But you auction off these securities at the time of issuance, like IPOs. But ICOs, you kind of give away the assets in exchange for something, for example, investments, and then you allow these insiders or these early investors to liquidate their holdings when it's listed on these security exchanges, such as Kraken, such as Binance, all these other. I think you guys should be quite familiar. Okay. Uh, from an investor's perspective, why should you care about crypto assets? Okay. Uh, the argument that's being proposed by, you know, financial planners or whatever is because you still want to try to diversify your portfolio. Okay, whatever that means. Okay. Uh, maybe they offer some inflation protection, as you'll find out that Bitcoin has, in the long run, zero inflation because there's a fixed amount of Bitcoin at 21 million. Maybe cryptocurrencies offer some liquidity ability. So, for example, if you're in a country that has capital controls, then you can switch your assets to some more liquid currency, which allows you to fleet, right? Move your assets quite quickly, which relates to economic mobility, right? I think this is probably the most important selling point because uh, literally you can just convert your currencies to cryptocurrencies, fly to somewhere else, and then you can start your life over as long as there's an exchange that's offering you to withdraw your money in that country. So I think this is probably the most compelling reasons why cryptocurrency has any value is because you can circumvent barriers propped up by financial institutions like the banking sector, like the CIA or whatever, right? So there's because there's anonymity in cryptocurrencies, you can circumvent these barriers and therefore you achieve economic mobility. All right, so those are the reasons why you should care. So if you're thinking about moving your money, diversification, maybe you're thinking about the VC industry, or maybe you're thinking about helping companies digitize their assets, these are all good reasons to focus on, just to think a little bit about more about digital assets and cryptocurrencies. All right, so before I talk about how Bitcoin works, okay, I will spend some time on how to value it using the stuff we already know from this class. Okay, so just to make the continuity transition from Forex into cryptocurrencies smoother. So let me jump to the last slide here. Um, so maybe before I do that, let me demonstrate how one would send or receive cryptocurrencies. So I forgot to do this. Let me do it now. Um, sorry. So what I'm going to do is I'm going to show you how to send the cryptocurrencies using what's called testnet Bitcoin. So like all software, there's always a backup copy of the software where you can, build apps and try to break it, but it's okay because if you break it, nothing of value is lost. It's just a test software. And so I'm going to try to send testnet Bitcoin to myself and then show you how long it really takes for, Bitcoin to actually to be sent. All right. So let me try to do that now. Let me see. I should have. Yes, I deleted. Hold on. I should have it here. Let me look for it. All right. Hmm. Oh, doesn't like that. Sorry, I'm trying to enter my testnet address. Um, All right, good. All right, so here is what's called a testnet faucet. That means that you can get some testnet Bitcoin that allows you to play around with to build software on it. So I'm going to send some Bitcoin to myself. Oh, it wants me to solve this puzzle. Fine. Verify. Okay. Oh, that's a bad address. Okay. Again, hold on, give me a second. Send, receive. Okay. U9. K 49 MH QFG5 8LC4 MZST. All right, let's hope this works. Still. All right, I'm gonna try a different one. Strange. Seven L 4 U. All right, cool. So you see, I sent some amount of money to some address. So that's was my address that was generated from my wallet. So there are instructions in the slides that give you instructions how to create a testnet Bitcoin wallet. And as long as you find one of these faucets, so if you want to play with it, here's a faucet, coinfaucet.eu. Okay, go there. Send yourself some money, and then you can track the transaction by clicking on this link. So I'm going to click on that. So this is called a block explorer. Okay, so that every transaction that's made on the Bitcoin is recorded and is publicly available. So as you can see, the transaction is not complete. In fact, the status is unconfirmed. That means that it hasn't been officially written on the blockchain. So it will take about, on average, 15 minutes for a block to be found and verified and validated, and therefore this transaction to be recorded on the blockchain. And typically you need 3 blocks on top of your transaction to be sure that your transaction is secure. So while we wait, okay, I'll just to demonstrate how long it takes. Okay, so right now I can refresh it and you'll see that's still unconfirmed, right? It's going to take a while, all right? So blockchain, remember, on Bitcoin takes on average 10 minutes for a transaction to be written. All right, so let's me talk about why we should, how to value Bitcoin. All right, so number one. So the first model we're going to look at is relative PVP. So remember what that tells us that in the long run, we can quantify the expected depreciation of a foreign currency or domestic currency in terms of inflation differentials between two countries, right? But we'll just assume that BTC is like a country. It pretty much is, right? You think of it that way. And then these two values can be decomposed, right? Pi can be decomposed into the speed at which money supply changed, right? Percent change MS, and also percent change uh, L, right? And for BTC, you can do the same. So here we have percent change in MS and also percent change in L. But if you understand, if you know some knowledge, if you have some knowledge about Bitcoin, you know that the monetary policy of Bitcoin is that it's eventually 0%, right? Money supply is fixed at 21 million, and so this number is 0, right?
we can get a number for this. We can get a number for this, right? In the long term, US probably will grow up 2%, right? So we'll probably do that. So around 2%, divided by 12, because we're gonna do monthly. Okay. Let's just say 2% per year. And we can also get an estimate uh or sorry, not this, but combined, right? This is 2%. And we can get an estimate on this, right? We can estimate the average return you get on Bitcoin month to month. And we can back out adoption rate, right? Just to give us an idea of how much demand there is for Bitcoin based on the the full sample average of monthly return and also the long-term inflation rate that the US has a target on. All right, so let's go ahead and do that. So how do we get a return for uh, E, right? So let's look at returns for Bitcoin. That's this one here. So let me tell you what Bitcoin return looks like. This is the distribution. Okay, so you can see that month to month return for Bitcoin. So here's the Bitcoin, the price of Bitcoin in terms of dollars. You can see that it has centrality at 0, but it also has large swings in month to month asset price. So here, this is not 1.5%. This is 150% increase. Okay. So you can see in many times that this is before 2019. Bitcoin over a single month can increase in value by 150% and also drop by 50% in a separate month. So very volatility is very high. And compared to other assets, so let me give you a sense of comparison. Here is S&P 500 returns, and here is gold returns. So you can see S&P 500 returns on average has positive centrality, but the most it can drop or increase over, again, the same time period, 2019, before 2019, is 10% and minus 5%, right? So not too crazy over a month. So these probably are small stock, right? Smaller companies, right? Most likely that are uh, having these large swings in asset prices. But for the most part, these guys are increasing in value. For gold, zero centrality, but again, the swings are not as bad, 15% up and down. And then compared to Bitcoin, 150% increase month over month is possible. Also 50% chance. 50% decrease is also possible. So pretty crazy, right? Okay, so if I take the average, so the mean here is around 21%, right? This is the mean or median return of month-to-month return of Bitcoin in terms of US dollars is 21%. So here we can plug in 21%. Suppose that the US has a targeted inflation of 2% and achieves that in the long run. So 2% divided by 12 will give us a month-to-month inflation rate of 0.16. So let's plug that in. And then we know that monetary policy of Bitcoin is 0%, right? Because in the long run, Bitcoin is fixed money supply. And so the adoption, long run adoption is this. Okay. So solving for the adoption rate, we see that it's 20%. And this is something you should be asking yourselves, do you think that month over month people are really adopting Bitcoin at a 20% rate? Does it make any sense? Are there specific goods and services that you're able to access that you can't access, like having US dollars, for example, to buy certain goods and services? And of course, I don't think so. And therefore, I think Bitcoin is primarily a speculative asset, more or less like a bubble. All right, if you're not convinced, that's fine. Let's try another way. Let's look at the quantity theory of money, which is again just a tautology, but again, we could back out the price given these inputs that we can observe, right? We observe quantity spent in US dollars. We can also observe the stock of Bitcoin over a fixed period of time, and it also has velocity. These numbers can be backed out. They're here. So if you haven't noticed, you can click on these links to find the source. So as of April 4th, 5 years ago, uh, the M times V is 85,000, around 85,000 Bitcoins. The quantity of money, in terms of dollars, transactions is $461 million. Given these two inputs, we can back out the price. This is the price of Bitcoin in terms of dollars. And if you take the inverse, that gives you the exchange rate in terms of dollars. And we find that the price of Bitcoin should be around $500. But at the time of I calculated this, the Bitcoin price was around $6,700. All right. So again, the gap between these two values suggests that there must be some irregularities with regards to the exchange rate price, right? This doesn't make much sense, right? This is fundamental, right? This has to be true, assuming you believe in the right. If you believe in the tautology here, but this one, the observed price, something is obviously exaggerated. All right. If those two frameworks of thinking still does not convince you that Bitcoin is a bubble, we can do a little bit more statistical analysis. So let's just look at Bitcoin in terms of momentum. Okay. So bubbly assets tends to be driven by attention and information, right? Release of information, even though it's non-informative information. Right, so let's try to see if there's how much momentum there is in Bitcoin versus other types of assets such as S&P 500 index and gold. So here, to look at how serially correlated returns on Bitcoin is, we can run the following regression. Here's the current period's return regressed. Sorry, the next period returns regressed on the current period's return, and we look at the estimated B, which will tell us how serially correlated returns are for S&P 500, gold, and Bitcoin. We see that the serial correlation for S&P 500 and gold is negative and also not statistically significant. Look at the t-stats, very low. But for Bitcoin, it's very serial correlated, positive, and large t-stat. Okay, so yes, it's seems like it's potentially a bubble. So that's number one. All right, attention. Let's look at how frequently people search for the term Bitcoin in Google. Right. So here's the index that proxies for how frequently Bitcoin is searched. And this bottom graph here, the graph on top is the Bitcoin price over the same period of time. So from 2013 to before 2019, same thing for Google Trends. We calculate the correlation coefficient. It's around 88%. Okay. So here's the plot, right, of Bitcoin price and Google Trends. So you can see that discussion is what drives the price, not anything fundamental here. Okay. If that's still not convincing that it's a bubble, okay, let's look at volatility, daily returns instead of monthly. Okay. So here, in comparison here, let's look at just drops in returns. So this is 5%, 10%, 15%, 20%, 25%, 30%. I'm comparing drops in value over a single day for S&P 500, gold, and Bitcoin across between 2011 to 2019. Okay. S&P 500 had only one day in which it's decreased by 5%. Okay. Across this time period. Gold had 3 days in which it decreased by 5%. Bitcoin decreased 5% over the same time period by 194 times. Okay. 10%, 81 times, 50%, 43 times, and so forth. Something crazy, right? For 30%. And remember, this is daily returns, okay? It's not monthly, okay? Not over a long period of time. It's not a trend here. It's just a daily switch, right? From positive to negative. So again, should be an indication of competition for attention. Attention and people's attention spans change quite frequently. So hopefully based on these empirical analysis and also the models you work with, you should take away the following things, okay? Number one, it appears that this digital gold claim about BTC, how it's a store of value, is unsupported because if you look at the correlation coefficient between gold and Bitcoin, it's essentially zero. All right. It's at the end of the day, I think it's not really a currency. It's again more like a commodity because you can't predict what its value is the next day. There's no one pays interest on it. Having Bitcoin doesn't give you any sort of access to any special goods or services, right? You hold dollars because you want to buy US goods, you hold Chinese yuan because you want to buy Chinese exports, etc. That's what currency is about. It's credit, it's extension of credit, it's borrowing and lending. But Bitcoin and all these other cryptocurrencies, they don't do that. So I think at the end of the day, it should be treated like a commodity. Okay. Uh, Lastly, but you probably don't notice this yet because I haven't explained to you what Bitcoin is. Bitcoin is not unique in the sense that I can easily create another copy. I can just copy and paste Bitcoin and just call that another blockchain. So people say that Bitcoin is a fixed supply of currency. I have doubts because there is money supply creation. It just takes the form of different cryptocurrency names. Like Litecoin, LTC, it's just a different version of Bitcoin. ETH is like Bitcoin, but different consensus algorithm, right? Just small differences. But in the end, all this all this stuff is just money creation out of thin air. I just created it out of nowhere. Uh, just like to some extent, just like fiat currency, but fiat currency at least it's a debt. You should think of it as debt. Bitcoin, Litecoin, it's not debt. It's not a credit extension. It's none of that. Okay. All right. So now we have that out of the way. Okay. Do you have any questions about, I guess, asset valuations from the models we have and also the empirical statistical analysis of Bitcoin? Otherwise, I'm going to play you a video that explains to you what Bitcoin is fundamentally, without diving too deep into the, the technical dimension of Bitcoin. But at least it gives you a very, very good foundational understanding of exactly what it is. Let's see. See if I have sound here. I hope. Okay, good. All right, just relax and enjoy.
What does it mean to have a Bitcoin? Many people have heard of Bitcoin, that it's a fully digital currency with no government to issue it, and that no banks need to manage accounts and verify transactions. And also that no one really knows who invented it. And yet many people don't know the answer to this question, at least not in full. To get there, and to make sure that the technical details underlying the answer actually feel motivated, what we're going to do is walk through step by step how you might have invented your own version of Bitcoin. We'll start with you keeping track of payments with your friends using a communal ledger. And then as you start to trust your friends and the world around you less and less, and if you're clever enough to bring in a few ideas from cryptography to help circumvent the need for trust, what you end up with is what's called a cryptocurrency. You see, Bitcoin is just the first implemented example of a cryptocurrency. And now there are thousands more on exchanges with traditional currencies. Walking the path of inventing your own can help to set the foundations for understanding some of the more recent players in the game and recognizing when and why there's room for different design choices. In fact, one of the reasons I chose this topic is that in the last year, there's been a huge amount of attention and investment and, well, honestly, hype directed at these currencies. And I'm not going to comment or speculate on the current or future exchange rates, but I think we'd all agree that anyone looking to buy a cryptocurrency should really know what it is. And I don't just mean in terms of analogies with vague connections to gold mining. I mean an actual direct description of what the computers are doing when we send, receive, and create cryptocurrency. One thing worth stressing, by the way, is that even though you and I are going to dig into the details here, and that takes meaningful time, you don't actually need to know those details if you just want to use the cryptocurrency. Just like you don't need to know the details of what happens under the hood when you swipe a credit card. Like any digital payment, there's lots of user-friendly applications that let you just send and receive the currencies without thinking about what's going on. The difference is that the backbone underlying this is not a bank that verifies transactions. Instead, it's a clever system of decentralized, trustless verification based on some of the math born in cryptography. But to start, I want you to actually set aside the thought of cryptocurrencies and all that just for a few minutes. We're going to begin the story with something more down to earth: ledgers and digital signatures. If you and your friends exchange money pretty frequently, paying your share of the dinner bill and such, it can be inconvenient to exchange cash all the time. So you might keep a communal ledger that records all of the payments that you intend to make some point in the future. Alice pays Bob $20, Bob pays Charlie $40, things like that. This ledger is going to be something public and accessible to everyone, like a website where anyone can go and just add new lines. And let's say that at the end of every month, you all get together, look at the list of transactions and settle up. If you spent more than you received, you put that money in the pot. And if you received more than you spent, you take that money out. So the protocol for being part of this very simple system might look like this. Anyone can add lines to the ledger, and at the end of every month, you all get together and settle up. Now, one problem with a public ledger like this is that anyone can add a line. So what's to prevent Bob from going and writing Alice pays Bob $100 without Alice approving? How are we supposed to trust that all of these transactions are what the sender meant them to be? Well, this is where the first bit of cryptography comes in: digital signatures. Like handwritten signatures, the idea here is that Alice should be able to add something next to that transaction that proves that she has seen it and that she's approved of it. And it should be infeasible for anyone else to forge that signature. At first, it might seem like a digital signature shouldn't even be possible. I mean, whatever data makes up that signature can just be read and copied by a computer. So how do you prevent forgeries? Well, the way this works is that everyone generates what's called a public key private key pair, each of which looks like some string of bits. The private key is sometimes also called a secret key, so that we can abbreviate it as SK while abbreviating the public key as PK. Now, as the name suggests, this secret key, it's something you want to keep to yourself. In the real world, your handwritten signature looks the same no matter what document you're signing. But a digital signature is actually much stronger because it changes for different messages. It looks like some string of ones and zeros, commonly something like 256 bits. And altering the message even slightly completely changes what the signature on that message should look like. Speaking a little more formally, producing a signature involves a function that depends both on the message itself and on your private key. The private key ensures that only you can produce that signature, and the fact that it depends on the message means that no one can just copy one of your signatures and then forge it on another message. Hand in hand with this is a second function used to verify that a signature is valid. And this is where the public key comes into play. All it does is output true or false to indicate if this was a signature produced by the private key associated with the public key that you're using for verification. I won't go into the details of how exactly both these functions work, but the idea is that it should be completely infeasible to find a valid signature if you don't know the secret key. Specifically, there's no strategy better than just guessing and checking random signatures, which you can check using the public key that everyone knows. Now think about how many signatures there are with a length of 256 bits. That's 2 to the power of 256. This is a stupidly large number. To call it astronomically large would be giving way too much credit to astronomy. In fact, I made a supplemental video devoted just to illustrating what a huge number this is. Right here, let's just say that when you verify that a signature against a given message is valid, you can feel extremely confident that the only way someone could have produced it is if they knew the secret key associated with the public key you used for verification. Now, making sure that people sign transactions on the ledger is pretty good, but there's one slight loophole. If Alice signs a transaction like Alice pays Bob $100, even though Bob can't forge Alice's signature on a new message, he could just copy that same line as many times as he wants. I mean, that message signature combination remains valid. To get around this, what we do is make it so that when you sign a transaction, the message has to also include some sort of unique ID associated with that transaction. That way, if Alice pays Bob $100 multiple times, each one of those lines on the ledger requires a completely new signature. All right, great. Digital signatures remove a huge aspect of trust in this initial protocol. But even still, if you were to really do this, you would be relying on an honor system of sorts. Namely, requesting that everyone will actually follow through and settle up in cash at the end of each month. What if, for example, Charlie racks up thousands of dollars in debt and just refuses to show up? The only real reason to revert back to cash to settle up is if some people, I'm looking at you, Charlie, owe a lot of money. So maybe you have the clever idea that you never actually have to settle up in cash as long as you have some way to prevent people from spending too much more than they take in. Maybe what you do is start by having everyone pay $100 into the pot, and then have the first few lines of the ledger read, Alice gets $100, Bob gets $100, Charlie gets 100, etc. Now, just don't accept any transactions where someone is spending more than they already have on that ledger. For example, if the first two transactions are Charlie pays Alice $50 and Charlie pays Bob $50, if he were to try to add Charlie pays you $20, that would be invalid, as invalid as if he had never signed it. Notice, this means that verifying a transaction requires knowing the full history of transactions up to that point. And this is more or less also going to be true in cryptocurrencies, though there's a little room for optimization. What's interesting here is that this step removes the connection between the ledger and actual physical US dollars. In theory, if everyone in the world was using this ledger, you could live your whole life just sending and receiving money on this ledger without ever having to convert to real US dollars. In fact, to emphasize this point, let's start referring to the quantities on the ledger as ledger dollars, or LD for short. You are, of course, free to exchange ledger dollars for real US dollars. For example, maybe Alice gives Bob a $10 bill in the real world. In exchange for him adding and signing the transaction, Bob pays Alice 10 ledger dollars to this communal ledger. But exchanges like that, they're not going to be guaranteed by the protocol. It's now more analogous to how you might exchange dollars for euros or any other currency on the open market. It's just its own independent thing. This is the first important thing to understand about Bitcoin or any other cryptocurrency. What it is a ledger. The history of transactions is the currency. Of course, with Bitcoin, money doesn't enter the ledger with people buying in using cash. I'll get to how new money enters the ledger in just a few minutes. But before that, there's actually an even more significant difference between our current system of ledger dollars and how cryptocurrencies work. So far, I've said that this ledger is in some public place, like a website where anyone can add new lines. But that would require trusting a central location, namely, who hosts the website, who controls the rules of adding new lines. To remove that bit of trust, we'll have everybody keep their own copy of the ledger. Then when you want to make a transaction, like Alice pays Bob 100 ledger dollars, what you do is broadcast that out into the world for people to hear and to record on their own private ledgers. But unless you do something more, this system is absurdly bad. How could you get everyone to agree on what the right ledger is? When Bob receives a transaction, like Alice pays Bob 10 ledger dollars, how can he be sure that everyone else received and believes that same transaction? That he'll be able to later on go to Charlie and use those same 10 ledger dollars to make a transaction? Really, imagine yourself just listening to transactions being broadcast. How can you be sure that everyone else is recording the same transactions and in the same order? This is really the heart of the issue. This is an interesting puzzle. Can you come up with a protocol for how to accept or reject transactions and in what order, so that you can feel confident that anyone else in the world who's following that same protocol has a personal ledger that looks the same as yours? This is the problem addressed in the original Bitcoin paper. At a high level, the solution that Bitcoin offers is to trust whichever ledger has the most computational work put into it. I'll take a moment to explain exactly what that means, It involves this thing called a cryptographic hash function. The general idea that we'll build to is that if you use computational work as a basis for what to trust, you can make it so that fraudulent transactions and conflicting ledgers would require an infeasible amount of computation to bring about. Again, I'll remind you that this is getting well into the weeds beyond what anyone would need to know just to use a currency like this. But it's a really cool idea. And if you understand it, you understand the heart of Bitcoin and of other cryptocurrencies. So first things first, what's a hash function? The inputs for one of these functions can be any kind of message or file. It really doesn't matter. And the output is a string of bits with some kind of fixed length, like 256 bits. This output is called the hash or the digest of the message. And the intent is that it looks random. It's not random. It always gives the same output for a given input. But the idea is that if you slightly change the input, maybe editing just one of the characters, the resulting hash changes completely. In fact, for the hash function that I'm showing here, called SHA-256, the way the output changes as you slightly change that input is entirely unpredictable. You see, this is not just any hash function. It's a cryptographic hash function. That means it's infeasible to compute in the reverse direction. If I show you some string of ones and zeros and ask you to find an input so that the SHA-256 hash of that input gives this exact string of bits, you will have no better method than to just guess and check. And again, if you want to feel for how much computation would be needed to go through 2 to the 256 guesses, just take a look at the supplement video. I actually had way too much fun writing that thing. You might think that if you just really dig into the details of how exactly this function works, you could reverse engineer the appropriate input without having to guess and check. But no one has ever figured out a way to do that. Interestingly, there's no cold, hard, rigorous proof that it's hard to compute in the reverse direction. And yet, a huge amount of modern security depends on cryptographic hash functions and the idea that they have this property. If you were to look at what algorithms underlie the secure connection that your browser is making with YouTube right now, or that it makes with your bank, you will likely see the name SHA-256 show up in there. For right now, our focus will just be on how such a function can prove that a particular list of transactions is associated with a large amount of computational effort. Imagine someone shows you a list of transactions and they say, hey, I found a special number so that when you put that number at the end of this list of transactions and apply SHA-256 to the entire thing, the first 30 bits of that output are all zeros. How hard do you think it was for them to find that number? Well, for a random message, the probability that a hash happens to start with 30 successive zeros is 1 in 2 to the 30, which is about 1 in a billion. And because SHA-256 is a cryptographic hash function, the only way to find a special number like that is just guessing and checking. So this person almost certainly had to go through about 1 billion different numbers before finding this special one. And once you know that number, it's really quick to verify. You just run the hash and see that there are 30 zeros. So in other words, you can verify that they went through a large amount of work, but without having to go through that same effort yourself. This is called a proof of work. And importantly, all of this work is intrinsically tied to the list of transactions. If you change one of those transactions, even slightly, it would completely change the hash. So you'd have to go through another billion guesses to find a new proof of work, a new number that makes it so that the hash of the altered list, together with this new number, starts with 30 zeros. So now think back to our distributed ledger situation. Everyone is there broadcasting transactions, and we want a way for them to agree on what the correct ledger is. As I said, the core idea behind the original Bitcoin paper is to have everyone trust whichever ledger has the most work put into it. The way this works is to first organize a given ledger into blocks, where each block consists of a list of transactions together with a proof of work. That is a special number so that the hash of the whole block starts with a bunch of zeros. For the moment, let's say that it has to start with 60 zeros, but later we'll return back to a more systematic way you might want to choose that number. In the same way that a transaction is only considered valid when it's signed by the sender, a block is only considered valid if it has a proof of work. And also, to make sure that there's a standard order to these blocks, We'll make it so that a block has to contain the hash of the previous block at its header. That way, if you were to go back and change any one of the blocks, or to swap the order of two blocks, it would change the block that comes after it, which changes that block's hash, which changes the one that comes after it, and so on. That would require redoing all of the work, finding a new special number for each of these blocks that makes their hashes start with 60 zeros. Because blocks are chained together like this, instead of calling it a ledger, it's common to call it a blockchain. As part of our updated protocol, we'll now allow anyone in the world to be a block creator. What that means is that they're going to listen for transactions being broadcast, collect them into some block, and then do a whole bunch of work to find a special number that makes the hash of that block start with 60 zeros. Then once they find it, they broadcast out the block that they found. To reward a block creator for all this work, when she puts together a block, we'll allow her to include a very special transaction at the top of it, in which she gets, say, 10 ledger dollars out of thin air. This is called the block reward, and it's an exception to our usual rules about whether or not to accept transactions. It doesn't come from anyone, so it doesn't have to be signed. And it also means that the total number of ledger dollars in our economy increases with each new block. Creating blocks is often called mining, since it requires doing a lot of work and it introduces new bits of currency into the economy. But when you hear or read about miners, keep in mind that what they're really doing is listening for transactions, creating blocks, broadcasting those blocks, and getting rewarded with new money for doing so. From the miner's perspective, each block is kind of like a miniature lottery, where everyone is guessing numbers as fast as they can until one lucky individual finds a special number that makes the hash of the block start with many zeros, and they get the reward. For anyone else who just wants to use this system to make payments, instead of listening for transactions, they all start listening just for blocks being broadcast by miners and updating their own personal copies of the blockchain. Now, the key addition to our protocol is that if you hear two distinct blockchains with conflicting transaction histories, you defer to the longest one, the one with the most work put into it. If there's a tie, just wait until you hear an additional block that makes one of them longer. So even though there's no central authority and everyone is maintaining their own copy of the blockchain, if everyone agrees to give preference to whichever blockchain has the most work put into it, we have a way to arrive at decentralized consensus. To see why this makes for a trustworthy system, and to understand at what point you should trust that a payment is legit, it's actually really helpful to walk through exactly what it would take to fool someone using this system. Maybe Alice is trying to fool Bob with a fraudulent block. Namely, she tries to send him one that includes her paying him 100 ledger dollars, but without broadcasting that block to the rest of the network. That way, everyone else still thinks that she has those 100 ledger dollars. To do this, she would have to find a valid proof of work before all of the other miners, each working on their own block. And that could definitely happen. Maybe Alice just happens to win this miniature lottery before everyone else. But Bob is still going to be hearing the broadcasts made by other miners. So to keep him believing this fraudulent block, Alice would have to do all of the work herself to keep adding blocks on this special fork in Bob's blockchain that's different from what he's hearing from the rest of the miners. Remember, as per the protocol, Bob always trusts the longest chain that he knows about. Alice might be able to keep this up for a few blocks if, just by chance, she happens to find blocks more quickly than the rest of the miners on the network all combined. But unless she has close to 50% of the computing resources among all of the miners, the probability becomes overwhelming that the blockchain that all of the other miners are working on grows faster than the single fraudulent blockchain that Alice is feeding to Bob. So, after enough time, Bob's just going to reject what he's hearing from Alice in favor of the longer chain that everyone else is working on. Notice, that means that you shouldn't necessarily trust a new block that you hear immediately. Instead, you should wait for several new blocks to be added on top of it. If you still haven't heard of any longer blockchains, you can trust that this block is part of the same chain that everyone else is using. And with that, we've hit all the main ideas. This distributed ledger system based on a proof of work is more or less how the Bitcoin protocol works and how many other cryptocurrencies work. There's just a few details to clear up. Earlier, I said that the proof of work might be to find a special number so that the hash of the block starts with 60 zeros. Well, the way the actual Bitcoin protocol works is to periodically change that number of zeros so that it should take, on average, 10 minutes to find a new block. So as there are more and more miners added to the network, the challenge actually gets harder and harder in such a way that this miniature lottery only has about one winner every 10 minutes. Many newer cryptocurrencies actually have much shorter block times than that. And all of the money in Bitcoin ultimately comes from some block reward. In the beginning, these rewards were 50 Bitcoin per block. There's actually a great website you can go to called Block Explorer that makes it easy to look through the Bitcoin blockchain. And if you look at the very first few blocks on the chain, they contain no transactions other than that 50 Bitcoin reward to the miner. But every 210,000 blocks, which is about every 4 years, that reward gets cut in half. So right now, the reward is 12.5 Bitcoin per block. And because this reward decreases geometrically over time, it means there will never be more than 21 million Bitcoin in existence. However, this doesn't mean that miners will stop earning money. In addition to the block reward, miners can also pick up transaction fees. The way this works is that whenever you make a payment, you can purely optionally include a little transaction fee with it that's going to go to the miner of whichever block includes that payment. The reason you might do that is to incentivize miners to actually include the transaction that you broadcast into the next block. You see, in Bitcoin, each block is limited to about 2,400 transactions, which many critics argue is unnecessarily restrictive. For comparison, Visa processes an average of about 1,700 transactions per second, and they're capable of handling more than 24,000 per second. This comparatively slow processing on Bitcoin makes for higher transaction fees, since that's what determines which transactions miners choose to include in a new block. All of this is far from a comprehensive coverage of cryptocurrencies. There are still many nuances and alternate design choices that I haven't even touched. But my hope is that this can provide a stable wait-but-why style tree trunk of understanding for anyone looking to add a few more branches with further reading. Like I said at the start, one of the motives behind this is that a lot of money has started flowing towards cryptocurrencies. And even though I don't want to make...
All right, so hopefully that gives you some insight into the technical aspects of Bitcoin. So let me just briefly point out the key takeaways, all right, from the video and kind of what I expect to, what you should expect to see and what can be tested in terms of Bitcoin. Uh, so the takeaways from the video is the following. Bitcoin is the entire ledger. So what that means is that you need every new Bitcoin is associated with a sequence of transactions. And so what that also means is that Bitcoin is not necessarily fungible because it's the entire history that determines that a Bitcoin has its own history. Every Bitcoin has its own history, and you can't delete those or ignore those transactions. It's the entire blockchain is secured through computers computing to solve a cryptographic puzzle, as you just saw. And you can think of it as just a very expensive lottery ticket in which you have to exert energy, right? Electricity to find the solve for that puzzle, solve the solution for that puzzle. And the whole point of doing all this is so that you can overcome this so-called double spending problem, right? So in the real world, the big problem is that people tend to forge currencies, like they take the money, they put it in a computer, or they duplicate the plates and they make fake money. Well, in digital space, you have to go through all this layers of complexity so that you can avoid this double spending, right? Just copy and pasting code, right? In which yeah, so that's the whole point. The whole point. All right. So the proof of work consensus algorithm has a name. It's called the Nakamoto consensus. So again, it's consensus because you should only trust the blockchain that has the most computational work, right? So just remember, proof of work means trust the blockchain, trust the version of the chain that has the most computational work applied to it. All right. So of course, the trade-off of all this decentralized verification, in which we don't have banks anymore, we don't have validators, we just have a decentralized space of people solving cryptographic puzzles to extend the chain. you're subject to what's called a 51% attack. But of course, this is very unlikely. You would need 51% of computational power over long periods of time to actually, break the blockchain. But of course, for less frequently used, less frequently mined blockchains, 51% attack is quite frequent. But of course, Bitcoin is where most transactions take place in the cryptocurrency space, and so this is very unlikely. All right. So let me conclude by talking about should Bitcoin have any value? So this is my take on Bitcoin. It should have value because it's censorship resistant. So if you want to send money to anybody, you can. There's no institution blocking you from doing this. It's borderless, so there's not by country, it's nationless. So if you want to move money, for example, out of China into China, you can do it. As long as you have the internet, it's possible. The monetary policy is transparent, meaning that you know exactly how the money supply grows. There's no monetary policy uncertainty. Inflation is 0% as well. But of course, this is subject to change if miners all vote to change the code base. And lastly, it's immutable in the sense that it's very, very, very difficult to undo transactions or impossible to undo transactions. So if you made a mistake and you want to undo it, it's impossible. That's how it is. That's the feature. It's a feature of the Bitcoin. It's not a a bug or anything that. So proof of work just makes it very, very expensive to correct things. So if it's in there, it's in there, and that's it. Okay. All right. Why it shouldn't have value. So as I mentioned earlier, Bitcoin is, you know, you can create another version of Bitcoin by simply copying and pasting the code base and creating your own currency and finding miners willing to mine it, right? So Litecoin is one example where it's almost a copy of Bitcoin and a little modification. And if you have people who are willing to mine it, you just created another blockchain. You just created money out of thin air. So it's possible. And the way you should think about Bitcoin, at least from my perspective, is to think about Bitcoin as like social media company. So as you probably can imagine, before Facebook, there were several other social media companies in which people, exhibited themselves, posted pictures, whatever, and such as MySpace or Friendster. You may have no idea what I'm talking about, but these were social media companies that existed before Facebook arrived. But these companies all had value before Facebook. It's only when people left these platforms in favor of Facebook in which their values became zero. So say for Bitcoin, there's no guarantee that people will stick with Bitcoin. Maybe there's superior technology that arrives sometimes in the future. And if people abandon Bitcoin, nobody wants to make transactions, nobody wants to mine it, then Bitcoin could lose all its value. Right? That's the idea. All right, so that's my take. So that's the end of the topics I want to talk about for this class. So if you have questions about what was presented today in terms of cryptocurrencies or options, you can talk to me now. Otherwise, next week is going to be fully dedicated to review. And of course, I will tell you the topics that will be on the exam so that you don't waste time studying stuff that's not on the exam. All right, so I'll see you guys next week. Just remember to sign in if you haven't, and yep, see you guys. Oh, so I forgot to. So let's see if it's confirmed. Yep. So within that time span, I started. So there are 13 confirmations. So there you go. So I think that's now you can be fairly confident that your transaction is it now exists on the blockchain because now there's 13 additional blocks in front of your transaction. Right. All right. Just to give you a taste of making transactions on Bitcoin.